How to Trade Stocks Using Artificial Intelligence in the United States of America. Part 1. Introduction, Foundations, and the Role of AI in Modern Stock Trading. 1. Introduction. The integration of artificial intelligence AI into financial markets has revolutionized how investors analyze data, predict market movements, and execute trades. In the United States, which hosts the largest stock market in the world, AI-driven trading systems are widely used by hedge funds, institutional investors, and increasingly by retail traders. AI has transformed traditional investment strategies by enabling machines to process massive volumes of financial data and detect patterns that humans may overlook. Stock trading historically depended on human intuition, manual analysis of financial statements, and technical chart analysis. However, with the explosion of financial data, social media sentiment, real-time economic indicators, and high-frequency market transactions, it has become impossible for humans alone to analyze all available information effectively. Artificial intelligence fills this gap by using machine learning, deep learning, and advanced algorithms to evaluate data and generate trading signals. In the United States, financial institutions such as quantitative hedge funds employ AI models to predict price movements and execute algorithmic trades. For example, the hedge fund, the Volian Group, uses machine learning systems to analyze market data and develop profitable trading strategies, managing billions of dollars in assets. Wikipedia. AI-powered trading has also become accessible to individual investors through platforms that automate technical analysis, scan financial news, and generate predictive insights. These technologies are reshaping the landscape of stock trading by improving efficiency, reducing emotional decision-making, and enabling data-driven investment strategies. This discussion explores how AI can be used to trade stocks in the United States, covering the fundamental concepts, tools, strategies, benefits, risks, and future developments in AI-driven trading. 2. Overview of the United States stock market. To understand how AI is used in stock trading, it is important to first understand the structure of the U.S. stock market. The United States has the largest and most liquid equity market in the world. Major stock exchanges include New York Stock Exchange (NYSE), NASDAQ, Chicago Board Options Exchange (CBOE), American Stock Exchange (MX). These exchanges facilitate the buying and selling of shares in publicly listed companies such as Apple, Microsoft, Tesla, Amazon, and Google. The U.S. stock market operates during regular trading hours from 9:30 a.m. to 4 p.m. Eastern Time, with additional pre-market and after-hours trading sessions. Millions of transactions occur every day, generating vast quantities of financial data. This data includes price movements, trading volumes, order book information, financial statements, earnings reports, macroeconomic indicators, news sentiment, social media discussions. Artificial intelligence systems analyze these datasets to identify patterns and forecast potential price movements. 3. What is artificial intelligence in stock trading? Artificial intelligence in stock trading refers to the use of computer algorithms that learn from historical data and market conditions to make investment decisions. AI trading systems can perform several functions: market analysis, stock prediction, trade execution, risk management, portfolio optimization. Machine learning models are trained on historical market data to identify patterns that may repeat in the future. These models improve their predictions as they process more data. Recent research has demonstrated that advanced AI models can discover hidden patterns in financial data and produce profitable trading strategies without relying solely on traditional indicators. ArcSiv. 4. Types of artificial intelligence used in stock trading. Several AI technologies are used in modern trading systems. 4.1 Machine learning. Machine learning allows computers to learn from data and improve predictions without explicit programming. Common machine learning methods used in trading include regression models, decision trees, random forests, support vector machines. These algorithms analyze historical stock prices, financial indicators, and economic data to predict future price movements. 4.2 Deep learning. Deep learning is a subset of machine learning that uses neural networks with multiple layers to analyze complex patterns. Deep learning models are particularly useful for time series forecasting, pattern recognition, sentiment analysis, high-frequency trading. These models can process unstructured data such as news articles, social media posts, and earnings call transcripts. 4.3 Reinforcement learning. Reinforcement learning is another AI technique used in trading. It trains algorithms to make decisions through trial and error. The system receives rewards for profitable trades and penalties for losses. Over time, the algorithm learns optimal trading strategies. Frameworks like Finro provide tools for developing reinforcement learning-based trading agents capable of automated portfolio management. ArcSiv 5. How AI works in stock trading. AI trading systems generally follow a structured process. Step 1. Data collection. AI requires large datasets to function effectively. Data sources include stock prices, market indices, financial reports, economic indicators, news articles, social media sentiment. Financial platforms like Google Finance provide real-time market data and financial information that traders can analyze. Wikipedia. Step 2. Data processing. Raw financial data must be cleaned and processed before analysis. Data preprocessing involves removing errors, handling missing data, normalizing values, converting data into machine-readable formats. This step ensures accurate model predictions. Step 3. Model training. Once the data is prepared, machine learning models are trained using historical market data. The model identifies relationships between variables such as price patterns, trading volume, market sentiment, economic indicators. The goal is to develop predictive models capable of forecasting stock price movements. Step 4. Backtesting. Before deploying an AI trading system in real markets, traders must test it using historical data. Backtesting simulates how the strategy would have performed in the past. It helps traders evaluate profitability, risk levels, drawdowns, strategy robustness. Algorithmic trading. Platforms such as QuantConnect allow traders to build and test trading algorithms using historical market data. Wikipedia. Step 5. Strategy deployment. Once the trading algorithm performs well during backtesting, it can be deployed in live markets. The AI system monitors market conditions in real time and executes trades automatically based on predefined rules. 6. AI trading strategies used in the United States. AI systems employ several trading strategies. 6.1 Algorithmic trading. Algorithmic trading uses predefined rules to automatically execute trades. These rules may include price thresholds, moving averages, market momentum indicators. AI improves algorithmic trading by allowing systems to adapt to changing market conditions. 6.2 High-frequency trading HFT. High-frequency trading involves executing thousands of trades within milliseconds. AI algorithms analyze market microstructure data and exploit small price inefficiencies. HFT firms use powerful computers and low-latency networks to gain an advantage over competitors. 6.3 Sentiment analysis. Sentiment analysis involves analyzing news articles, financial reports, and social media discussions to determine market sentiment. AI models process large volumes of text to identify positive or negative sentiment about a company or the overall market. For example, AI systems can analyze earnings call transcripts to detect changes in management tone that may influence stock prices. 6.4 Event-driven trading. Event-driven trading focuses on major corporate or economic events that influence stock prices. These events may include earnings announcements, CEO changes, regulatory actions, mergers and acquisitions. AI platforms can scan financial news and filings to detect events that historically lead to price movements. Levelfields.ai. 7. Popular AI tools for stock trading. Several AI-powered trading tools are used by investors in the United States. Trade Ideas. Trade Ideas is a popular AI-powered stock scanner that provides trading signals based on machine learning algorithms. Its AI assistant analyzes market data and suggests potential trading opportunities. Ideasher. TrendSpider. TrendSpider automates technical analysis by detecting chart patterns and trend lines automatically. This helps traders identify support, resistance, and breakout opportunities quickly. Levelfields.ai. WealthLab. Another platform is WealthLab, which allows traders to build and test trading strategies using technical indicators and historical data. Wikipedia. 8. Benefits of using AI in stock trading. Artificial intelligence provides several advantages to traders. 1. Speed. AI systems can analyze massive datasets in seconds. 2. Data processing. AI can analyze structured and unstructured data simultaneously. 3. Emotion-free trading. Human traders often make decisions based on fear or greed. AI eliminates emotional bias. 4. Continuous monitoring. AI systems monitor markets 24 hours a day. 5. Strategy optimization. Machine learning algorithms continuously improve trading strategies. 9. Limitations and risks of AI trading. Despite its advantages, AI trading also has limitations. Market uncertainty. Financial markets are influenced by unpredictable events. Data bias. AI models may produce inaccurate predictions if trained on biased datasets. Overfitting. Models may perform well during backtesting but fail in real markets. Regulatory challenges. Regulators may impose restrictions on automated trading systems. Conclusion Part 1. Artificial intelligence is transforming stock trading in the United States by enabling investors to analyze massive data sets, identify patterns, and automate trading decisions. AI-driven trading systems combine machine learning, deep learning, and algorithmic strategies to enhance trading efficiency and profitability. From institutional hedge funds to individual investors, AI tools are becoming an essential part of modern trading strategies. However, successful AI trading requires careful strategy development, risk management, and continuous monitoring of market conditions. 10. Building an AI-based stock trading system. Developing an AI-based stock trading system involves combining financial knowledge, programming skills, and data science techniques. The goal is to create a system capable of analyzing large volumes of financial data and making intelligent trading decisions. The development process typically follows several stages. 10.1 Defining the trading objective. Before creating an AI trading system, a trader must define clear objectives. These may include short-term trading, day trading, or swing trading, long-term investment strategies, portfolio optimization, risk reduction, automated trading. For example, some traders may want an AI model that predicts daily stock price movements, while others may want a system that automatically buys undervalued stocks. The objective determines the type of data required, the algorithm used, and the trading strategy. 10.2 Data acquisition. Artificial intelligence relies heavily on data. The accuracy and effectiveness of an AI trading model depend on the quality and quantity of data available. Common sources of stock market data include historical stock prices, trading volume, financial statements, macroeconomic indicators, corporate earnings reports, news articles, social media sentiment, analyst ratings. In the United States, traders often obtain data from financial platforms such as Yahoo Finance, AlphaVantage, Quandl, Bloomberg Terminal, Nasdaq Data Link. These platforms provide real-time and historical data necessary for training AI models. 10.3 Data preprocessing. Raw financial data is usually messy and requires cleaning before it can be used in machine learning models. Data preprocessing involves removing duplicate entries, filling missing values, converting text data into numerical values, normalizing price data, detecting outliers. For example, news headlines can be converted into numerical values using natural language processing (NLP) techniques so that AI models can analyze sentiment. 10.4 Feature engineering. Feature engineering involves selecting and creating important variables that influence stock price movements. Examples of features used in AI trading models include technical indicators, moving averages, relative strength index (RSI), Bollinger Bands, MACD, momentum indicators, fundamental indicators, price-to-earnings ratio (PE), earnings per share, revenue growth, debt-to-equity ratio, market sentiment indicators, news sentiment scores, social media trends, analyst recommendations. Proper feature engineering significantly improves the predictive performance of AI models. 11. Programming languages and tools for AI stock trading. Several programming languages and frameworks are commonly used to develop AI trading systems. 11.1 Python. Python is the most widely used programming language for AI trading. Reasons for its popularity include simple syntax, extensive libraries, strong community support, powerful data analysis capabilities. Python libraries used in AI trading include NumPy, Pandas, Scikit-learn, TensorFlow, PyTorch, Keras, Stats models. These libraries enable traders to build complex machine learning models capable of analyzing financial markets. 11.2 R programming. R is another programming language widely used for statistical analysis and financial modeling. It provides powerful tools for time series analysis, statistical modeling, data visualization, Financial econometrics. However, Python is generally preferred for large-scale AI systems. 11.3 Machine learning frameworks. Machine learning frameworks simplify the development of AI models. Common frameworks include TensorFlow. TensorFlow is a deep learning framework developed by Google. It is widely used for building neural networks capable of predicting stock price movements. PyTorch. PyTorch is another powerful deep learning library used by researchers and quantitative traders. Scikit-learn. Scikit-learn provides simple machine learning algorithms suitable for classification, regression, clustering, data preprocessing. 12. AI algorithms used in stock trading. Several machine learning algorithms are commonly applied in stock market prediction. 12.1 Linear regression. Linear regression is one of the simplest models used to predict stock prices. It estimates the relationship between a stock's price and other variables such as trading volume, interest rates, market indices. Although simple, regression models can still provide valuable insights. 12.2 Decision trees. Decision trees classify market conditions based on different variables. For example, a decision tree may determine whether to buy or sell a stock based on price trend, volume changes, technical indicators. Decision trees are easy to interpret and useful for rule-based trading strategies. 12.3 Random forest. Random forest is an ensemble learning method that combines multiple decision trees to improve prediction accuracy. This algorithm reduces overfitting and provides more reliable predictions. 12.4 Support vector machines. SVM. Support vector machines are used for classification problems such as predicting whether a stock price will rise or fall. They work by identifying optimal boundaries that separate different market conditions. 12.5 Long short-term memory networks. LSTM. LSTM networks are a type of deep learning model designed for time series data. Since stock prices change over time, LSTM models are particularly effective in predicting market trends. They can learn long-term relationships between past and future prices. 13. Backtesting AI trading strategies. Backtesting is one of the most important steps in developing AI trading systems. It involves testing a trading strategy using historical market data to determine how it would have performed in the past. Key metrics used during backtesting include total return, Sharpe ratio, maximum drawdown, win-loss ratio, profit factor. Backtesting helps traders evaluate whether their strategy is profitable before risking real money. 14. Risk management in AI stock trading. Risk management is essential in any trading strategy. Even the most advanced AI models cannot predict markets with 100% accuracy. Important risk management techniques include diversification. Diversification involves spreading investments across different stocks or sectors to reduce risk. Stop-loss orders. Stop-loss orders automatically sell a stock when its price drops to a certain level. This prevents large losses. Position sizing. Position sizing determines how much capital should be allocated to each trade. Professional traders often risk only 1 to 2% of their capital per trade. Portfolio optimization. AI algorithms can optimize portfolios by balancing risk and return. 15. Regulation of AI trading in the United States. AI-driven trading is regulated by several financial authorities in the United States. Major regulatory bodies include Securities and Exchange Commission (SEC), Financial Industry Regulatory Authority (FINRA), Commodity Futures Trading Commission (CFTC). These organizations ensure that trading practices remain fair and transparent. Algorithmic traders must comply with regulations related to market manipulation, insider trading, high-frequency trading rules, data transparency. Regulators also monitor automated trading systems to prevent market instability. 16. Real-world applications of AI in stock trading. Many large financial institutions already use AI for trading. Examples include hedge funds. Quantitative hedge funds rely heavily on AI algorithms to identify profitable trading opportunities. Investment banks. Investment banks use AI for market forecasting, risk management, portfolio allocation. Retail trading platforms. Modern trading platforms now provide AI-based tools that help individual investors make better decisions. 17. Advantages of AI trading over traditional trading. Artificial intelligence provides several advantages compared to traditional trading methods. Faster decision-making. AI systems analyze data much faster than human traders. Ability to process big data. AI can analyze millions of data points simultaneously. Continuous learning. Machine learning algorithms improve over time as they process new data. Reduced emotional bias. AI systems follow data-driven rules rather than emotional impulses. 18. Challenges of AI in stock trading. Despite its benefits, AI trading faces several challenges. Overfitting. Models may perform well during testing but fail in real markets. Data quality issues. Poor quality data can lead to inaccurate predictions. Market volatility. Unexpected events such as economic crises can disrupt AI models. Technical complexity. Developing advanced AI trading systems requires specialized expertise in finance, programming, and machine learning. 19. Ethical considerations. AI trading raises several ethical concerns. For example, high-frequency trading may disadvantage smaller investors. AI algorithms may create unfair market advantages. Automated systems may contribute to market volatility. Regulators and financial institutions continue to debate how to balance innovation with fairness. 20. Future of AI in stock trading. The future of AI trading looks promising. Several emerging technologies are expected to further transform financial markets. Quantum computing. Quantum computing may dramatically improve the speed of financial simulations and market predictions. Advanced deep learning. More sophisticated neural networks will improve market forecasting accuracy. Autonomous trading systems. Future trading systems may operate entirely autonomously with minimal human intervention. Integration with blockchain. Blockchain technology could improve transparency and security in financial markets. Conclusion. Artificial intelligence is transforming stock trading in the United States by enabling investors to analyze massive data sets, identify hidden patterns, and execute trades automatically. AI technologies such as machine learning, deep learning, and reinforcement learning have significantly improved the ability to predict market movements and manage investment portfolios. From hedge funds to individual retail investors, AI trading tools are becoming increasingly accessible. These systems offer numerous advantages, including faster decision-making, improved data analysis, and reduced emotional bias. However, AI trading also presents challenges, including model overfitting, regulatory concerns, and unpredictable market conditions. Successful AI trading requires careful strategy development, proper risk management, and continuous model improvement. As artificial intelligence technology continues to evolve, it is expected to play an even greater role in the future of financial markets. Traders who understand how to integrate AI into their investment strategies will likely gain a competitive advantage in the increasingly data-driven world of finance. Below is a further expanded academic discussion on how to trade stocks using artificial intelligence in the United States of America. This section continues the previous material and adds deeper explanations on AI, data science techniques, AI trading models, infrastructure, portfolio management, practical implementation, and global participation in U.S. markets. How to trade stocks using artificial intelligence in the United States of America. Further expanded discussion. 21. Data science in AI stock trading. Data science forms the backbone of artificial intelligence trading systems. In the context of stock trading, data science involves collecting, analyzing, and interpreting financial data to generate meaningful insights that can guide investment decisions. Financial markets generate enormous amounts of data every second. This includes price movements, order flows, news updates, economic reports, and investor sentiment. Artificial intelligence systems rely on data science techniques to process this information and extract patterns that can help predict market behavior. Data scientists working in financial trading environments perform several important tasks: collecting historical financial data, cleaning and organizing data sets, identifying useful financial indicators, developing predictive models, evaluating model performance. One major advantage of AI-powered data science is the ability to analyze big data. Big data refers to extremely large datasets that cannot be processed using traditional methods. For example, AI systems can analyze millions of tweets, financial news headlines, and trading signals to determine whether market sentiment is positive or negative toward a particular company. Data science also enables predictive analytics, which involves using historical data to forecast future stock price movements. Predictive analytics has become a core component of algorithmic trading systems used by financial institutions. 22. Natural language processing in stock trading. Natural language processing (NLP) is an important branch of artificial intelligence used to analyze Text-based information in financial markets. Financial markets are heavily influenced by information released through news articles, corporate earnings reports, press releases, analyst recommendations, social media discussions. NLP algorithms analyze this textual data and determine whether the sentiment is positive, negative, or neutral. This process is known as sentiment analysis. For example, if many news articles report strong financial results for a company, an NLP system may classify the sentiment as positive. This may signal a potential increase in the company's stock price. Similarly, if social media discussions show growing concern about a company's financial health, AI systems may interpret this as a negative sentiment signal. Advanced NLP models can also detect subtle linguistic patterns in earnings calls and management speeches. Changes in tone, word choice, or confidence level may indicate shifts in corporate outlook. These insights allow traders to react quickly to new information before it is fully reflected in stock prices. 23. Reinforcement learning in AI trading systems. Reinforcement learning is one of the most advanced artificial intelligence techniques used in stock trading. Unlike traditional machine learning methods that rely on labeled data, reinforcement learning involves training an algorithm through a system of rewards and penalties. The algorithm learns by interacting with a simulated trading environment. The reinforcement learning process involves three main components: agent, the AI trading algorithm; environment, the financial market; reward system, profit or loss generated by trades. The AI agent continuously experiments with different trading strategies. If a strategy produces profit, the algorithm receives a reward. If the strategy leads to losses, the algorithm receives a penalty. Over time, the algorithm learns which actions maximize profit and minimize risk. Reinforcement learning has become particularly popular in automated portfolio management, where AI systems dynamically adjust asset allocations in response to market conditions. 24. Infrastructure required for AI trading. Developing and operating AI trading systems requires specialized technological infrastructure. Large financial institutions invest heavily in computing resources to support algorithmic trading operations. Key components of AI trading infrastructure include high-performance computing. AI trading models often require powerful computers capable of processing large data sets quickly. High-performance computing systems allow traders to run complex machine learning algorithms and backtesting simulations efficiently. Cloud computing. Cloud platforms such as Amazon Web Services, Oz, Google Cloud, and Microsoft Azure provide scalable computing resources for AI trading. Cloud computing allows traders to access powerful servers without purchasing expensive hardware. Data storage systems. AI trading systems require large databases to store historical market data. These databases store information such as historical stock prices, trading volumes, economic indicators, financial statements. Proper data storage ensures that AI models can access historical data for training and analysis. Low latency networks. Speed is extremely important in modern financial markets. Many algorithmic trading firms use low latency networks that allow them to transmit trading orders within microseconds. Faster execution speeds can provide a competitive advantage in high-frequency trading environments. 25. Portfolio management using artificial intelligence. Artificial intelligence is widely used for portfolio management. Portfolio management involves selecting and managing a group of investments to achieve specific financial objectives. AI systems can analyze thousands of stocks simultaneously and identify optimal investment opportunities. AI portfolio management systems perform several functions: asset allocation, risk analysis, performance monitoring, portfolio rebalancing. For example, an AI system may determine that technology stocks are currently outperforming other sectors. The system may automatically allocate more capital to technology stocks while reducing exposure to weaker sectors. AI systems also monitor portfolio risk by analyzing volatility and correlations between different assets. 26. Robo-advisors. Robo-advisors are automated investment platforms that use artificial intelligence to manage investment portfolios. These platforms are particularly popular among beginner investors who may not have extensive financial knowledge. Robo-advisors typically perform the following functions: assess investor risk tolerance, create diversified portfolios, automatically rebalance investments, provide investment recommendations. Examples of robo-advisor platforms used in the United States include Betterment, Wealthfront, Schwab Intelligent Portfolios. These platforms use AI algorithms to construct portfolios based on modern portfolio theory and risk optimization models. 27. AI trading strategies used by professional traders. Professional traders and hedge funds employ several AI-driven strategies. Statistical arbitrage. Statistical arbitrage involves identifying price discrepancies between related financial instruments. AI algorithms analyze historical relationships between stocks and detect temporary price deviations. For example, if two companies historically move together but suddenly diverge, an AI system may exploit the opportunity by buying one stock and short-selling the other. Momentum trading. Momentum trading focuses on stocks that are moving strongly in one direction. AI systems identify stocks experiencing strong upward or downward momentum and generate trading signals. Mean reversion. Mean reversion strategies assume that stock prices tend to return to their historical average levels. If a stock becomes significantly overvalued or undervalued, AI algorithms may initiate trades expecting the price to return to its average. Market making. Market making algorithms provide liquidity to financial markets by continuously buying and selling stocks. These algorithms profit from the difference between bid and ask prices. AI improves market-making strategies by adjusting prices dynamically based on market conditions. 28. Steps for beginners to start AI stock trading. Individuals interested in AI stock trading can follow several steps. Step 1. Learn basic stock market concepts. Understanding fundamental financial concepts is essential before using AI trading systems. Key topics include stock valuation, technical analysis, risk management, portfolio diversification. Step 2. Learn programming and data analysis. Programming skills are necessary for building AI trading models. Python is the most recommended language for beginners. Step 3. Study machine learning. Basic knowledge of machine learning helps traders understand how AI models make predictions. Important topics include regression models, classification algorithms, neural networks. Step 4. Practice with simulated trading. Before trading with real money, beginners should practice using simulated trading environments. Simulators allow traders to test AI strategies without financial risk. Step 5. Deploy AI trading systems. Once a strategy is proven effective, it can be deployed in real markets using brokerage platforms that support algorithmic trading. 29. Participation of international traders in U.S. stock markets. Investors from around the world can participate in the U.S. stock market. Many international traders use online brokerage platforms to access U.S. stocks. These platforms provide tools that support algorithmic trading and AI-based analysis. International investors must comply with U.S. financial regulations and tax requirements when trading American stocks. 30. Risk factors in AI-based stock trading. While AI trading systems can improve trading performance, they also involve risks. Important risk factors include model failure. AI models may stop working effectively if market conditions change. Over-optimization. Excessive optimization during backtesting may lead to unrealistic results. Market crash. Unexpected financial crises can disrupt AI trading strategies. Technical failures. System errors or network disruptions may lead to trading losses. Effective risk management is necessary to mitigate these risks. 31. The future of AI in financial markets. Artificial intelligence is expected to play an increasingly important role in global financial markets. Future developments may include fully autonomous trading systems, AI-driven financial forecasting, integration with blockchain technology, advanced predictive analytics. As computing power continues to increase, AI models will become more sophisticated and capable of analyzing even larger datasets. The financial industry is moving toward a future where investment decisions are increasingly supported by intelligent machines. Final conclusion: artificial intelligence has fundamentally transformed stock trading in the United States. Through advanced algorithms, machine learning models, and large-scale data analysis, AI systems can identify trading opportunities, predict market movements, and execute trades with remarkable speed and efficiency. AI trading systems are now widely used by hedge funds, investment banks, and retail investors. These systems provide numerous advantages, including improved decision-making, reduced emotional bias, and the ability to analyze vast amounts of financial information. However, successful AI trading requires careful model design, continuous data analysis, and strict risk management practices. As financial technology continues to evolve, artificial intelligence will remain a central force, shaping the future of stock market trading. Don't forget to subscribe, like, and share for more tips.